Hey there, everyone. Welcome to Chart This with Dave Keller. It's Thursday, February 20th, and I'm your host, Dave Keller, coming to you from back home in Redmond, Washington. Rainy day here, and the snow has finally melted. We ended up having about 8 inches of snow on the ground here in the far east suburbs of Seattle. Even though closer to the city, it went away quite some time ago. It was lingering, and while I was at the Money Show in Las Vegas, it looks like the end of the snow season, at least for now, is behind us. It was such a pleasure to speak at the Money Show Las Vegas this week. I just traveled back yesterday. That's why we didn't have a live show yesterday. Apologize for that. Just couldn't fit it into the schedule of getting back home to Seattle, which I was excited to do. But really enjoyed giving a presentation called the 4 Deadly Sins for Investors. I had a great interactive group of people with some really thoughtful questions, and that was a lot of fun. Also did 4 episodes of my podcast, which we recorded on Tuesday from the show. Lindsay Bell, Christina Hooper. Who else did I sit down with? Keith Fitzgerald. Who was it? Oh boy, who was the last one? Jordan Kimmel, I want to say, who I'd not met before, but I'd followed his work and actually got to sit down with him. I think that's correct. Jordan Kimmel. Yeah, Jordan, apologize for that. But some really interesting points about mindfulness, about mindset for investing with Jordan, about quantitative strategies and identifying micro opportunities within a macro environment, with Lindsay talking about the challenges individual investors face and some of the ways that they can improve on their decision making, with Christina Hooper at the end of the day, who's the chief strategist at Invesco. We talked about all things Fed, about interest rates, about the dollar, about allocations, and so many other things. So we'll hopefully get those out to you as soon as possible. I'm trying to capture all the video and audio from the conference and produce those podcasts for you, hopefully over the next week. But should be really, really interesting information for all of you. But great to be back home. Good to be back with my family, and good to be back with you guys doing the show here. Sort of overall, not a great day for stocks, I would say. It wasn't an end of the world day. 3 out of the 11 S&P sectors finished in the green, but that means 8 of them finished in the red. It was enough to, potentially move the short-term model on the mid-cap stock index, the S&P 400 bearish. Breadth was not particularly strong today, more down than up, or more decliners versus advancers, and some defensive sectors toward the top of the leaderboard. That's it for an introduction. Let us get to the charts here and see how things actually played out. So you'll see a lot of red on the front page, except for the VIX, which was in the green today. Still pretty low. We'll get back to that in a second. The Dow leading the way lower, down 1%, and you can see the S&P 600 small cap index down about the same. The S&P and the NASDAQ both down just under 0.5% today. Now, they were down a lot more earlier in the day. The S&P actually got down to below 6,100 in the first half of the trading day. In the afternoon, sort of after lunch Eastern time, kind of a nice steady incline to finish stronger. However, still obviously a pretty good day in the red overall. So the S&P down, closing just below 61,018 today. So holding above that 6,100 level, but getting close to it. NASDAQ 100 down about 0.5% as well. And as I mentioned, the VIX moving higher, and still low though, right? The VIX in the low teens or mid-teens, that is, means a low volatility environment. Not much to be worried about until and unless the VIX starts to push above around the 20 level is what I would be looking for. Not there yet. Looking at the fixed income markets, you can see bonds rally today. So this is a stocks down, bonds up kind of day. The TLT, which is sort of a long duration treasury ETF, up about 0.33%. Interest rates generally moved lower today. You can see the 10-year point finished today right around 4.5%. The long bond yield just about 4.7%. And the 5-year point just below 4.35. So we are seeing a bit of a counter trend move with bonds rallying a bit here. The dollar index continuing to come down, and that's been one of the biggest changes, I would say, from Q4 of last year to Q1 of this year. Big shift, right? Because the dollar was strengthening really from kind of August, September through the end of the year. Dollar looking stronger and stronger. Year to date, dollar down. As a result, U.S. underperforming non-U.S. stocks. And that in particular was one of the themes. Talked about that with a couple of my podcast guests, but particularly Christina Hooper of Invesco. We talked about that weaker dollar environment, how we should be thinking about non-U.S. allocations versus U.S. allocations and so forth. You can see the dollar basically went down through the course of the day. Looking at the commodity space, gold continues to shine relative to stocks. Gold has outperformed the S&P and most equity indexes I can find year to date. Boy, Germany might be better than gold. I actually didn't think to pop that on there. I'll do that because I did grab a chart of the performance year to date of gold versus some equity indexes. I'll make a mental note to add the EWG on there. We'll see. I'm not sure actually. Silver, copper, crude oil, all in the green today. Some of the commodities were down, but most of these commodity ETFs remaining in the green. Cryptocurrencies getting better, right? So cryptocurrencies have started to improve a bit. The problem is Bitcoin is still well below those all-time highs, just over 108,000. After rallying for 2 straight days, Bitcoin's still around 98,000, still about 10,000 points below where we were at that all-time peak. So I would say at best, Bitcoin is still a range-bound chart. If you take a step back, right? When in doubt, zoom out, take a step back from your monitors. Bitcoin's kind of sideways at best at the moment. However, I think a clear trajectory to break out. We just have to finally do it and follow through, right? Get above 100,000 and hold, and that's what we've been unable to do here in this kind of basing pattern on the chart of Bitcoin. Mixed results from some of the other top coins here tracked on the stock charts platform. Looking at the major S&P sectors here in the U.S., you can see only 3 of them in the green, and not the kind of offense that would make you feel all warm and fuzzy about a bullish market environment. That's one issue I'm detecting in this particular market. You're seeing energy continue to sit on the top of the leaderboard. That's happened a lot here in the last week or two. We grabbed the chart of DVN, I want to say, one of those energy stocks. I think it was Devon Energy that we grabbed to show the fact that it's actually rallied very, very nicely up to, arguably a pretty good resistance level, but nice rally here, undeniably so in the month of February. So the XLE at the top today, up 0.9%. Real estate number 2, up 0.7%. That's a fairly defensive sector. Healthcare number 3, up almost 0.6%. That's another kind of defensive sector, although there's quite a bit of variety in there. Utilities number 4, flat for the day, but again, also a fairly defensive sector. Financials at the bottom of the list, down 1.5%. Some of these charts like JP Morgan, Citigroup, Bank of America, I'm trying to think of what else is in that kind of buck. Goldman Sachs, these are stocks that have looked really, really good, have been making new all-time highs into this week, but all kind of getting dinged this particular week. So the XLF, the worst performer, far outpacing the other sectors, down 1.5%. Consumer discretionary, second from the bottom, down 0.9%. Tesla immediately comes to mind when I'm thinking of the XLY. Tesla and Amazon, those are your 2 biggest weights. Both charts struggling here a little bit in the month of February. Industrials, number 3 from the bottom, down 0.7%. So, to be clear, I mean, there are a number of headlines that really, really helped stocks to move downwards. We'll talk about Walmart. We'll talk about them sort of guiding a little bit lower through the course of the year. We'll talk about a decrease in defense spending and what that does to a high-flying stock like Palantir, that it turns out can actually go down if, a big source of their business is going to be smaller than expected. So all of those things reflected on the charts just fine. We'll dig into those one by one as we can. All right, let's look at the breadth conditions here briefly. I just want to show you this is kind of a negative breadth day, but if you look, right, large caps, the least bad out of all of these combinations, right? So this is looking at advancers and decliners for the major U.S. equity indexes. The S&P is right in the middle. It was almost a coin flip, right? 53% down, 47% up. So still more down than up. Totally fair. However, not by much, right? It was pretty close. Compare that to the NASDAQ composite, where it was a 2-to-1 ratio of stocks down versus up. Compare that to mid caps or small caps, which it was almost 70% of the index down versus 30% up. So the larger you were today, probably the better things went. However, I mean, generally looking at the New York Composite Index, which is a broad universe, bunch of different cap tiers all mixed together, 50% down day. So this was not a good day for stocks. For the record, though, there are always stocks that are up. So names like Hasbro, names like Smuckers, names like Ball Corp, Texas Instruments did just fine today. So friendly reminder to be looking at things like the market carpet or a heat map. Look at movers, look at stocks that are able to get things done on a day when many things are struggling. A key theme that with all those podcast interviews that I mentioned, again, which I'm looking forward to getting out to very, very soon. Every one of them, if I remember right, I asked them about the Magnificent Seven, right? It was like, are those names done in a leadership role? And if so, where are we going next? Right? Where's the emerging leadership? And I had some interesting responses. Not all the same, right? There's some different thoughts about what could, sort of step in and take this role. But one thing that was undeniable, I don't think any of them said the Magnificent Seven are the place to be. It was more of a, yes, they're clearly showing some rotation. And so let's talk about where some opportunities might emerge. NVIDIA actually was up today, up about 0.6%. Microsoft and Apple both up as well. But the problem was Netflix down almost 2%. Tesla continued to be in a very consistent and straightforward downtrend, I would argue, down 1.7%. Amazon down another 1.7%. That's why the XLY was your worst, one of the worst performing sectors, because Amazon, Tesla, both getting dinged today. Meta also, which has arguably been the best of this group of stocks, going down as well. And so what's interesting is, today, as I'm looking at the charts, I'm seeing Meta down, Palantir down, Walmart and Costco down, JP Morgan down. I've just named a bunch of stocks that made new all-time highs in the last week and have arguably been the undeniably strongest charts out of all, right? These have been just the nice, consistent uptrends, sort of going up while everything else has felt like it's kind of struggling a bit. Today, it's kind of like all of those names that had been doing so well kind of not doing well. So that idea of leadership rotation, which I talked about with Julius DeKempener when he came on my podcast in the last week or two, we talked particularly about that leadership rotation. I would argue a day like today really drives that home. Now, a lot of those charts, right? Like Meta is not a bad chart yet, right? At worst, it's not an exceptional chart. It's just a great chart, right? But it's still going up, right? We're still making higher highs and higher lows. And all those stocks that I just mentioned are still in primary uptrends by any technical measure I would apply to those charts. It's just in the short term, they're actually going down a bit. And what stinks is, or what hurts is, if you own these names and you're used to seeing them help your portfolios, a day like today can surprise you a little bit, and not in a good way. All I would remind you is make long-term decisions with long-term data. Make short-term decisions with short-term data. Do not make long-term decisions with short-term data. And that is a friendly way of saying don't use one day's move and go, uh-oh, the long-term trend is broken. It is very much not broken yet on any of those charts that I just mentioned. All right, let's look at the market carpet. This is a heat map style visualization. As you can see, very much a neutral day, right? You see a little bit in bright green. You see a little bit in bright red, arguably more bright red than bright green by my initial kind of view of this heat map. However, the average, I mean, if I would average out all of these little squares, I would say it's probably dead neutral, kind of even, if not slightly lower. So this is very much a modeled appearance. What that tells you is when the benchmarks are kind of flat, when the average stock is kind of flat for the day, focus on the things that are the outliers. Focus on the barbells, right? The things that were up a lot and things that were down a lot, because those are ones that did something different. That's where there could be opportunities. Certainly opportunities to manage risk and unwind unsuccessful positions, opportunities to find stocks that are thriving despite the broad market weakness. That's where we kind of want to focus our attention. To start off, though, I'm immediately drawn to some of the big red boxes because they're in some of those names that we mentioned. And these names that I'm going to point out here, the problem is these have been some of the top performers here over the last 6 to 12 months. Walmart and Costco, that's part of that big box retailer trade that has been so consistently profitable and so consistently strong. And the danger with those charts is at some point, some sort of news event, some sort of incremental new information changes that, consistent bullish thesis. That's what we got today, where Walmart comes out and says, basically it looks like 2025 may not be as awesome as we all want it to be. As a result, Walmart down about 6.5%, Costco down 2.6%. Looking at the financial sector, and again, we've been talking about financials because they've arguably been one of the better places to be in 2025. I stand by the fact that there's still a compelling place to be given the shape of the yield curve, given the interest rate environment. Today, though, a lot of those high-flying names getting dinged here. JP Morgan down 4.5%, Morgan Stanley, Goldman Sachs, Citigroup down as well. Someone mentioned in the chat Visa, and again, Visa's down a bit today, not as much as some of those others, down about 1.3%, but 100% agreed. This is one of those names, among others, making new 52-week highs earlier this week, making new all-time highs earlier this week, and now coming off of it. So with all of those charts, as a reminder, this is one day. So I wouldn't be scared out of a position just because of one day. It probably doesn't feel good if you own them, but you've been feeling pretty good for a while. So I guess it happens. However, I would say, remember, take a step back and really think about what the trend is. And I would say in an uptrend, you have big down days. That's actually just the nature of stock trading. That's what makes it not as easy as you want, because even if it's going to appreciate over a longer period of time, it doesn't just go in a slow and steady straight line. It kind of fluctuates, what we call impulse moves and corrective moves. This is one of those corrective moves until the move is so negative that you have to say, okay, now this is a different type of trend. But for now, I would say overall, these charts are still in pretty decent shape. Also worth noting, in the upper left corner, this is the technology sector. Look at Apple, Microsoft, and NVIDIA. Now, granted, none of these had blowout up days, but they definitely didn't go down, right? So that's where you actually had some stability within that mega cap growth space. And I think that's maybe telling that those are some of the names that actually held in okay. Elsewhere in technology, you can see charts like Oracle, really made a new high in November and has struggled to sort of regain that momentum. That is a chart I'd probably be less excited about owning at the moment, because we're making a pretty clear pattern of lower highs. When that changes, I think I would get interested. But when I think of charts like Oracle, it reminds me of a chart like Tesla, which is kind of making this nice consistent pattern of lower highs and lower lows. That's the kind of chart I like to avoid until the chart tells you it deserves a space in your portfolio. And then look at all of the green over here in pretty defensive sectors. When you ignore Walmart and Costco, arguably the two biggest consumer staples stocks, granted, but look elsewhere and you'll see a decent amount of green in here, right? Things, and I mentioned Smuckers, Tyson Foods. Now, again, Tyson's coming off of a kind of a low level, right? It got all the way down to 54 after topping out around 65 about 6 months ago. So it's been coming down, but it's rallying off of those lows. And when we talk about rotation, you talk about high-flying names starting to struggle, which we're seeing. You're seeing beaten down names like Tyson, like Smuckers, starting to bounce higher off of their lows. Energy stocks, which have arguably been some of the worst places to be, starting to make higher lows, starting to rotate higher a little bit as ConocoPhillips pushes above big round number resistance around 100. So those are some of the observations on here, looking across the board. Other one I would say would be with airlines. I actually wrote an article earlier today for CNBC Pro. So if you follow my work there, check out an article on American Airlines. Talked a little bit about the airline space, really focused on AAL. Not a great look, to be honest with you, on some of the airlines. UAL, arguably among the airlines, probably looks the best because it hasn't come down as much. But I would say all of them showing some pretty clear signs of distribution here over the last 2 to 4 weeks. Something to be cautious about for sure. All right, we are going to get to the chart review portion, but I do want to remind you, by the way, in case you missed it on my last show, I am doing a free webcast next week. That's on Wednesday, a week from yesterday, February 26th, 1 p.m. Eastern, 10 a.m. Pacific, called Finding Value, the Great Rotation of 2025. I kind of came up with this topic, and since that moment, I've started to see more and more of that rotation. What we're going to talk about are the Magnificent Seven and other leading growth names, which have been doing so well, starting to have kind of a question mark on their uptrends. Some of the names that have been beaten down, like energy, and others, starting to improve a little bit. Materials, all of a sudden, we're appearing at the top of the leaderboard. We'll talk about small caps, which have not been particularly strong, but what conditions would help small caps maybe start to outperform. We're going to look at all things rotation. We'll talk about some of the technical signals that describe that rotation and where we are seeing emerging opportunities in an uncertain time. So you can sign up for that free event at marketmisbehavior.com/value. You can scan the QR code on my blue shirt on your screen, and I will look forward to having you join me on that free event next Wednesday, the 26th. All right, let's continue on with the chart review portion. And then we'll take a question or two. By the way, I can't see questions you're putting on. I see questions coming in on YouTube and on the other platforms. We're streaming on LinkedIn, on Facebook, on X. I appreciate you tuning in live anywhere that you're at. And I appreciate the thoughtful questions you guys have popped in here. I'll try to take a question or two before we wrap the show. Anything we don't get to, we will put it into the mailbag. We're planning an all mailbag episode tomorrow on Friday. And I would love to answer one of your questions on the show. What's your impression when you look at the chart of the S&P? For me, I'm immediately drawn to the fact that higher highs from November to December, really from September to October to November to December, look how we had higher highs essentially on stronger momentum, right? The RSI is kind of making higher peaks each time we make a new high. That's good. That's kind of what you want to see in a healthy bull market phase. Look at how things changed over the last 2 to 3 months, where we kept making new highs. And in fact, this week, touching 6150 for the first time, but the RSI is continuing to slope downwards. That is not a healthy bull market sort of configuration, right? A healthy bull market, you see higher highs on stronger momentum. A questionable bullish move is when you have higher highs on weaker momentum. That's called a bearish momentum divergence. I'm seeing it here clearly on the chart of the S&P 500. We've highlighted it on a number of charts in recent months, in recent weeks. Alphabet comes to mind, Synchrony Financial, SYF, so many others. I feel like every day or two I'm highlighting another one. And what concerns me is if you look back at a bunch of major market tops, which I've done, you often find a bunch of things showing these divergences, because at the end of a bull market, you just don't have as much momentum, right? We're still kind of drifting higher, but there's less momentum, because what happens is when there starts to be selling coming in, when people are kind of taking profits and unwinding positions and sort of happy to get out at or near highs, all of a sudden you start to see downward movements. And even though the general trend is still positive, there's enough momentum on those down days to change the momentum picture as measured by something like RSI. And so this most recent new all-time high this week, with the RSI down around 60 compared to the new high in early December with the RSIs around 70, that's a pretty big difference from a momentum perspective. And I think that's a concern as I'm looking at the S&P. To be clear, though, we made a new all-time high yesterday, so things are not that bad, right? I mean, as always, I'm looking for signs that we should start to be cautious, start to be concerned. I'm seeing some of those. Do I see any signs in the trend of the S&P that tells me we're not going up anymore? I do not. My market trend model is still bullish on all time frames, and I will tell you when that changes. For now, it tells me the primary uptrend is still good. I'm just seeing those signs that tell me to expect a limited upside beyond what we've experienced so far, and just make sure that I have a good stop loss in place for any positions that I'm currently holding. And I hope you are doing the exact same thing. In terms of breadth conditions, we mentioned how the breadth today was not particularly robust. I will tell you, though, I mean, one of the things that is not negative about what I'm seeing in the market right now, while we're not seeing an expansion in new 52-week highs, we are seeing a decent number of stocks making new 52-week highs on an average day. This isn't updated just yet for today's session, but up through yesterday, up through Wednesday's close, you had, 29 S&P names making a new 52-week high on Wednesday's session. That's about 6% of the index. Now, it's not 50% of the index. So to be clear, right, it could be much better, but it's not like there's zero stocks, right? There are still stocks making new 52-week highs. Now, today, that probably number is probably a lot lower, because not as many stocks, and a lot of those names that have been going up did not make a new high today. They kind of pulled back a little bit. But up until today's session, the new highs have actually been enough that it's not worrisome yet. If you would see the market start to roll over, if you start to see the green bars here go away, which would mean a lot less new highs, start to see the emergence of red bars, which would mean stocks actually making new 52-week lows, that would be a big danger sign here in February going into March. We've not seen that yet, but that's why I think that chart is an important one to keep handy. Also, and again, I felt myself getting pretty negative here as I'm reviewing the evidence, and I just want to highlight that as one thing that's not negative yet. Another thing that's not negative would be the volume. Now, the volume has been lower than you'd want in an uptrend, right? I mean, if you look at the trend in volume over the last 4 weeks, you're seeing a lot of volume on down days, and you're seeing a general downtrend in the average volume reading, really from early January to now late February. However, the chicken money flow is still quite positive, and that's what's actually encouraging. The chicken money flow actually looks at where we close within the range every day. So it's a little more of a arguably a more effective way of measuring the directional volume, I would say, than just looking at a simple volume reading. Because when you see this volume reading, you see a big red bar, you assume that's an entire day's worth of negative volume. That's not the case, right? There's plenty of accumulation probably happening during that day. It's just we closed lower than the previous close. The chicken money flow actually looks at the trend in the volume and where we close. So stronger directional days are weighted more. And so it really is a better representation of accumulation and distribution. And as you can see from the indicator, it's actually quite strong. It's more consistent with a bull market phase than a bearish phase. And we're not seeing any divergences. We're not seeing any deterioration in accumulation as measured by the chicken money flow. So again, at some point that will change and it'll probably go down. And one of the things you look for, as you can see by how many times I've highlighted it, is when we make new highs on weaker chicken money flow. That's what happens a lot at the end of a bull phase, is you start to see these big distribution days. And even though the trend is still okay, there's a lot of selling that's happening into strength. we're not necessarily seeing that as measured by Chaikin money flow. So that's not too bad yet. Sentiment data came out here Wednesday into Thursday. So I just want to update you on the weekly sentiment numbers. The AAII survey had been quite negative last week. We were down to almost 48% or so bears, which is one of the highest readings you'll see, certainly the highest reading we've seen in the last year or so. But if you look back to October of 2023, you can see the last time that the bearish sentiment got that negative was here at the October 23 low. So a lot of times in really strong deterioration phases, the sentiment will go so negative, it's kind of a contrarian bullish sign. Here's the problem, though. Look at January 2022. That's another time when it had not been anywhere near 48, 50%. All of a sudden it got down there. You think, great, buying opportunity. Right? I mean, that ended up being the beginning of a long period of time where the indicator actually remained fairly weak. So this is a little, I mean, I've found sentiment indicators like the AAII survey are not great timing tools. They're helpful as descriptive tools. They tell you about the mindset of investors. I've always found relying more on measures of trend and breadth are better timing tools. Those tell you when things are actually moving in a particular way. The sentiment, especially survey data, is more subjective, and it's more kind of measuring the sentiment, the mindset of investors. For what it's worth, though, the negative sentiment from last week, a little less negative here. We're down around 41% bearish, around 29% bullish. So not a big change in bulls, which means a lot of bears became neutral over the last week. As the S&P pushed to new all-time highs, the spread is still favoring bears over bulls. It's been negative for most of the early days here of 2025. All right, the name exposure index upticked quite a bit here, which tells you that respondents in this name exposure index, the name survey, a little less negative here. We were around 75% allocated to equities, according to this survey last week. This week, we're up to over 91%. So suggesting that money managers in this survey actually going a little more risk on this week. That's one of those things. I mean, when you see this start to, really, when you see this one get to an extreme high reading, that's when I get nervous, because that often happens going into a major top. The fact that we're not up to those extreme readings yet tells me to not be too worried, particularly based on that indicator. All right, here's the chart. I did make a mental note. I can't believe I actually remembered to do this. So, boy, surprises still happen. All right, I'm going to add the EWG. I've not looked at this up until this moment, so I don't know where it's going to be relative to others. We're going to make it pink just so it stands out here. All right, there we go. Look at that. Germany has outperformed gold year to date. Who knew? I guess it was in the back of my head somewhere. I was thinking, so, the point of this chart here is to show that, let me just save this and we'll go back. The point of this chart is to show the relative performance, or really the performance year to date of gold versus other. Oh boy, hold on. Now I completely messed up my list. Sorry, I can't multitask it that well. That's the problem here. All right, we get back here. Let's go to this one. And did that work? There we go. All right, sorry about that. So the point of this chart was to show that while we're seeing a bit of a deterioration now this week from the major equity averages, a reminder when we talk about leadership rotation, this is one of the things we'll talk about on the webcast next week, is the fact the Magnificent Seven are no longer leadership. As a group, it's not a leadership group anymore. There are stocks within that, like a Meta, like a Netflix, which look better than the others by far. And I think there's starting to be sort of a differentiation between that group of stocks. The MAGS ETF year to date is up 1%. The S&P and the equal weighted S&P are about even, just over 4%. The NASDAQ 100 up 5.1%. Gold up 12%. That is a big gap between the Magnificent Seven and gold, right? Talk about rocks over paper. That's basically what that comparison is showing you. And again, there are a lot of reasons why gold should or should not be going up. As a technical analyst, I'm much less interested in the general reasons as to why the chart is working. I am much more laser focused on the fact that I want to own things that are doing better than average, and gold is definitely still in that place. It outperformed the major averages in most of 2024, is outperforming year to date here. Full disclosure, I do own GLD because it's going up a lot. Now, what's interesting to me is while we can have this comparison to the U.S. indexes, look outside the U.S., like Germany. This is the EWG, and I apologize, I don't have that labeled. The EWG, which is a U.S.-listed iShares ETF owning German stocks or with exposure to the German equity markets. up almost 14%. So outperforming gold and by far outperforming the US indexes. Now, US over non-US was the story through pretty much all of 2024. Strong dollar, a big part of that story. The leadership and the growth leadership, a big part of that story. All of a sudden, 2025, the AI kind of mega cap growth trade no longer working as well. That does not help the US relative performance. All of a sudden, the dollar weakening, that does not help US relative performance. So the things that fueled US outperformance through pretty much all of 2024 are no longer really happening in the first 6 weeks of the new year. So, if you don't own stocks outside the US and you are a US based investor, number one, I don't blame you because it's not been a great place to be. However, I would blame you if you continue to ignore them because the charts are telling you that places like Germany, like Switzerland, other developed European countries are actually doing quite well, and that weaker dollar is a part of that thesis. Charts like Amazon are coming down. I mentioned how the XLY is one of the worst performers today. You can see in the month of February, Amazon went from making a new all-time high at the beginning of this month to now sort of breaking below its 50-day moving average for the first time since, really last summer. However, I would tell you, what concerns me about the chart of Amazon, we're not holding the 50-day. That's not great. We have a clear bearish momentum divergence. We mentioned that earlier on the S&P. Here's another great example for Amazon, and many other stocks are kind of flashing that pattern. The new highs in January, February were driven by less momentum. That's not healthy. But the charts are still okay, right? We're still making higher highs and higher lows. And that's why that swing low around 216 for Amazon is so important. That's where I'm making an alert. I'm actually making a note to do that right now because I've learned if I don't make alerts, then I forget to check. Although Amazon's one of those stocks I look at pretty much every day, but let's do it. This is an important level because that was the high from November. We broke out. We then tested that level as support. So it's called a pivot point. If we can hold that pivot point, things are okay. If we don't hold that pivot point, I think things get pretty ugly or certainly have the potential to get ugly very, very quickly. Tesla is one of those that actually does have a clear pattern of lower highs and lower lows. From mid-December now to mid-February, the chart's been going down. I would say with Tesla, the trick is you draw trend lines, right? Don't be afraid to use charts as a conversation you're having with the markets. This is how I would draw this particular trend line there. That's basically the high from mid-December. That lines up really well for the high from mid-January and late January. You can see that's well above current levels, currently around 380, we'll call it. So as long as we remain below that trend line, the stock's going down. The momentum is clearly negative. It's not bullish anymore. It's in the bearish range. The relative performance is underwhelming. So this is a stock going down. So stocks going down are the kind of things I want to avoid and wait until the chart tells me, hey, dude, you need to own it in your portfolio. I think breaking above that trend line at least could be the beginning of that kind of signal. But for now, I think Tesla in a downtrend. Let's talk about Palantir. Again, this has been one of the best charts here for quite some time. Technology name that's not really part of the Magnificent Seven, although given its performance, you probably could mentally, add this and remove some other names that don't look as good, and you'd probably have a more magnificent basket of stocks. But this week now starting to show some pain. Now, yesterday was pretty rough because we didn't quite have a bearish engulfing pattern. We definitely had a pretty big down move. A bearish outside day is what you call that from bar chart analysis. Today, we traded lower but closed higher. What's interesting is I don't have the gap range notated, but if you look from, we'll call it 100 to 84, that's the gap here from early February. That was their latest earnings report. And we gapped higher. We continued to trend higher. We've been overbought. All of a sudden, we're coming out of that overbought region, but we held the 100 level. We held the upper end of that gap. I would say as long as it holds that 100 level, we're still in great shape. We break 100, we're in okay shape. We break the 50-day, we break that swing low. It's not a great chart anymore. I mean, it's a good chart at best. And so that's kind of the varying levels of breakdown. I wouldn't be scared out of a stock like this just on what I've seen in the last 2 days. But I would say, and remember, this is one of the things that actually came up at the Money Show. I had a number of questions about what to do when different signals happen. And what I reminded people is, if you own a bunch of Palantir, what's happened is as this stock has gone, the stock's gone up a ton from 30 in early September to 125 a couple of days ago on an adjusted basis. That's a big move in 4 or 5 months. So if you did buy some Palantir back there and you still own it, that position has become a pretty big position, or probably much bigger than what you started with in terms of the weight of your portfolio. So I wouldn't be opposed to trimming some of that, certainly on the way up, because what you don't want is your entire portfolio to be driven by one stock. And that's what happens if you let a winning position just continue to grow and grow and grow. All of a sudden, it's 20, 30, 40% of your portfolio. I don't know about you, but I don't like the risk of having one stock be the bet that I'm making, right? I want to be making bets on a group of stocks that I think have good potential, not on one name. So what an institutional investor, what a pro would do is start to lighten up and trim positions on the way up so that it doesn't become a huge overweight. And I would be thinking about that as well. And remember, it's not, don't think I own 100% or I own 0%. You got a lot of room between 100 and 0%. You can cut 10%, 20%, a quarter of your position, still have plenty of exposure to Palantir, but at least take some off the table and minimize your, or at least, lessen your losses if we do continue to go lower. Those are some general thoughts on how I would approach a chart like Palantir. And again, chart's still okay. Walmart and others that have had big down days today, we'll talk about some of the financial stocks as well. Again, still okay from a long-term perspective, right? If you take a step back, we're still making higher highs and higher lows. We're just in a pullback phase within that uptrend. And so the trick now is differentiating a pullback that could make a higher low and a great entry point versus the beginning of something really disastrous. And the problem is at the beginning, they actually look very similar. The question is, do we hold support? Do we hold moving averages? Do we hold trend lines? Those are the things I would be looking for. The chart like Walmart, I'd be drawing a trend line off of these lows. I'd be watching the 50-day moving average, which has held incredibly well since the beginning of 2024. So let's assume that that's going to continue until it doesn't. Look at these pullbacks over the last 18 months where the RSI has hit around 40 as we hit the 50-day moving average. Those end up being great entry points, right? Great secondary entry points. So let's see if that's going to happen again. And if not, what would not look like? Well, we break below the 50-day, the RSI pushes below 40. Worst case scenario, we break below that low from early 2025, around $90. Then I think that's an ugly chart you probably want to get out of the way of. But for now, still okay. So keep an eye on these kind of tactical pullbacks and see if they violate more longer-term thresholds that are a problem. Walmart, of course, coming down because lowered expectations for the year. Costco and some of the other big box retailers coming down as well. Costco is notable to me because it really hasn't had a bearish momentum divergence from December through February. A lot of charts did, like Amazon we saw earlier. Costco has not. It's actually been going higher on stronger momentum. That's all pretty good. It is coming out of the overbought range, which basically means we're pulling back, right, within an uptrend. But again, same thing happens. We've got the 50-day moving average. We have the swing lows from January. That's your potential downside. So if you can't handle that kind of downside, that's what you want to think about. Could I deal with downside to 900 for an opportunity to ride it to 1200? And if not, if you can't handle that path, then get out of it and move on to something else that doesn't have that risk of doing that particular move. But we have to understand that uptrends are made of higher highs and higher lows. And again, overall, the primary trend is still positive on Costco. JP Morgan, again, made a new all-time high yesterday. So today is one day, but it's down 4.5%. As with all of these names, I would be watching swing lows. I would be watching the 50-day moving average. Healthy bull market phases have pullbacks, but they hold support. When we don't hold support on the pullback, that's when we want to start to get nervous, which means you're risking a little bit of movement above that moving average, but you're not scared out too early. Now, what's actually working here? Some energy stocks, to be honest with you. I mean, when I'm looking at which sectors are actually improving this week, energy is probably top of the list in terms of names starting to rally, maybe consumer staples and others as well. You can see that the last couple of days on DVN have been pretty strong. This is after earnings on Tuesday, I believe. Gapped higher yesterday, continue to follow through higher. We're really close to what I would consider an entry point, which is getting a confirmed move above that January peak. We've already kind of confirmed a breakout above a most recent trend line, but a little more conservative play would be way above that July breakout. The higher low around 33 with the RSI bottoming out around 40 is kind of a classic bullish rotation. We now have stronger momentum characteristics. I'd keep an eye on DVN and see if we see further appreciation. Got a question about Cal-Maine. I think this is on my YouTube channel in the comments. Egg prices obviously are kind of nutty right now. They've gone up quite a bit. CALM is a name that is a play on that space. What concerns me about this chart, and the short answer is it's not a good chart at the moment, and I will tell you why. Look at the clear divergence from December, January, February. Look at these new highs on weaker momentum. This is why we watch for bearish momentum divergences. When I see those divergences, that's why I look for breakdowns of key support levels like swing lows, like the 50-day moving average. All those things have broken in the last week. That's why a chart like this, I'd probably be out. I'd be avoiding it. We also broke below a big round number support level around 100. If this is still a bullish chart, those kind of levels would hold. When they don't hold anymore, I want to go find something else. I want to find a better place for my capital and wait for this chart to tell me it deserves a position in my portfolio again. I would say for now, broken chart showing some concerning movements. Carnival Cruise Lines, I forgot this is going to be a bit of a broken record with the bearish divergences, but here's yet another one. Now, compared to Calmain, Carnival's still okay because it's holding that January low. But today we almost got right down to breaking it. Earlier in the day, I was like, ooh, this is happening today. It didn't quite happen, right? So we held that January low. It's around 23.25, still down almost 6% today. We did rally going into the close, but I would say very close to a pretty negative breakdown for Carnival. I think Carnival below 23 is a pretty broken chart and one I would probably avoid. The mags now, the lags, I like that. I've actually had some great suggestions. The lag 7, the lags, I like those. That's a good. I think that's my current working title. The meager 7 is a close second, maybe. Keep the ideas coming. If you get hit with some creativity and you want to share, please let me know. All right. Question 3P Investor. Thanks as always for watching, my friend. You asked, I am glad you enjoyed the money show in Sin City. Yeah, me too. And to be honest, I'm not a big Vegas fan. That is not a lot of what I try to do in my life is not kind of the Vegas lifestyle. However, it's really fun to be there for a short window of time. I enjoy being there, and the company and the camaraderie and connections to be made far outweighs my discomfort with that particular city. But overall, I enjoyed being there very much. I'm also glad to back home safe. Me too. What was the overall mood of speakers in the money show, bullish or bearish? Oh, that's actually a really thoughtful question. I appreciate you asking. That's one of the things I love doing when I go to a conference like this is just kind of get the vibe. Now, I will tell you, when you're a speaker at an event like that and you have a lot of things you need to do, your ability to go in and check out other presentations is limited. So what I try to do is ask people that I'm meeting, who have you heard from? What stood out to you? What did you think was interesting? I would say this is a very measured presentation, generally speaking, right? I mean, and what I mean is I've been to, money shows in 2024 during the great bull market of 2024, and it was like kind of long and strong. Things are great. This chart's breaking out. This chart, you get a 52-week high. You get it, like they're all working. This was not one of those. This was a lot more about rotation. I mean, and again, the fellow speakers that I asked, where are you thinking right now? The general answer was something along the lines of like, obviously something's different, right? So I think we're all kind of struggling to figure out what's different. I think what was interesting is that there was no clear thesis by my gathering of what that next thing is, right? I had some people telling me, we're rotating away from the Magnificent Seven, and we've seen the move into value sectors like financials, materials, industrials. That's just the beginning. I think that's the next big move. I had some that say small caps could actually be in a leadership role. Here are some of the reasons why that could be part of the thesis. One really interesting one, I think this was Lindsay Bell, who I interviewed for my podcast. Again, I'm really excited to share that interview. It was really, really good. She was awesome. I'd not met her before or interviewed before, and I really appreciated her thoughts and perspective. Her comment was, maybe it's not a rotation away from tech and growth into value. Maybe it's from certain tech and growth into other tech and growth. And I would say one big thesis that came out of that conversation and a bunch of others was the fact that AI in 2024 was a very narrow theme, right? It was all about chip makers, NVIDIA and AMD and others that are at the forefront of AI, Alphabet and Meta, and who's going to leverage AI. These are the big winners, and then everyone else kind of missed it. The new rotation is the fact that a lot of other things can benefit from AI, and certainly people that were on the fundamental side that listened to companies' earnings reports said, yeah, everyone that I'm hearing is talking about how much they use AI, right? I mean, and you have to at this point, I think, regardless of what kind of company you own, you better be talking about AI or you're going to get some heat for it. But I think that is a very real, idea. Maybe the benefits of AI, the bullish sentiment for AI maybe comes not just from a narrow group of stocks, which is what we saw last year. Maybe it's more of a broader thing. And maybe the opportunities that are AI related are less concentrated and are more diverse in different sectors. That was kind of one of the really interesting points that I drew out of some of those conversations, a bunch of different conversations. That's kind of how I would summarize it. We are long on time. There are some thoughtful questions in here that I do want to get to. I'll have to save it for my my show tomorrow. We'll do an all mailbag episode tomorrow on Friday. But I have to thank you guys so much for joining me here today. It is great to be home. And again, a number of you said hello and introduced yourself at the Money Show in Las Vegas. It was so nice to meet you guys. I really appreciate you sharing some thoughtful feedback and experiences using my work and using technical analysis. I wish you guys the best, and look forward to meeting some of others on the show today at a future event. I will be around, and I hope to meet you at a future one. For now, I will say good night. I'm Dave Keller with Market Misbehavior. Have a good one, and remember, it is always a good time to own good charts. Take care, folks.